What do you think of when you hear Wall Street? Cutthroat competition, unbridled greed? Mostly true. But there's one firm, one legend, that has not only survived but dominated for over a century in this brutal arena. They're admired, they're reviled, but one thing is undeniable. They are the masters of risk management on Wall Street, a culture that cultivates ruthlessness, where for them to be winners, there had to be losers.
Goldman Sachs. Their name is synonymous with power, money, and financial secrets few ever uncover. Today, we're not just telling their story, we're decoding the core strategies that allow them to weather every crisis, multiply their wealth, and dominate the financial world. More importantly, we're going to extract the investment, business, and personal growth lessons directly from Goldman Sachs' playbook. Lessons that, if you truly understand and apply them, could completely transform your own financial future. Get ready, because what you're about to hear might change how you see money and power forever. Chapter 1. The Origins of Dominance, Identifying Unmet Needs. Rewind to 1869. A Jewish immigrant named Marcus Goldman, after making a small fortune from his clothing business, spotted a fatal flaw in the nascent financial market. He realized small businesses were desperate for quick cash, but big banks were too rigid. Marcus Goldman found a market gap. He offered to buy their short-term debts at a discount, then resold them to other investors and bankers for a higher price.
This was the foundation of commercial papers, a multi-billion-dollar market today. The first lesson from Goldman Sachs: spot the real unmet demand in the market. Don't follow the herd. Find a problem others are ignoring and solve it. In just 10 years, Marcus Goldman built an empire. But to truly grow, they needed the next big thing. What was it? By the late 19th century, the next big thing was taking companies public, IPOs. This is when a private company sells shares to the public for the first time, a highly complex process traditionally reserved for elite firms with European heritage.
Goldman Sachs, as a Jewish firm, was considered an outsider in the Wall Street establishment, but that didn't stop them. The second lesson: don't be afraid to break the rules. If you want to enter the giants' game, you have to forge your own path. And how did they do it? By looking within their own community.
Chapter 2. The Breakthrough and Strategic Alliances, when outsiders change the game. In 1897, Sears, a burgeoning retail giant, was looking to IPO. They were a perfect candidate, but too big for Goldman Sachs to handle alone. So what did Goldman Sachs do? They forged a strategic alliance with another up-and-coming Jewish firm, Lehman Brothers. Together, they underwrote a massive amount of stock for Sears, raking in unprecedented millions in fees. This wasn't just a deal. This was a statement on Wall Street. Goldman Sachs and Lehman Brothers proved they could do what the elite banks monopolized.
The third lesson: the power of synergy and going against the grain. Sometimes, to achieve massive goals, you need to seek partnerships, even with potential rivals. And don't be afraid to defy unwritten market rules. Their success attracted countless new clients, propelling Goldman Sachs to become a prominent investment bank on Wall Street by 1914. But IPOs are a cyclical business. When the market slows down, where do you find the next wave of profits? The timing was flawless for their next reinvestment, the Roaring '20s, a bull market unlike anything America had ever seen. Everyone was optimistic. Markets were soaring.
Chapter 3. The Art of Creating Money from Thin Air, Lessons from Bubbles and Crashes. Ever the opportunists, Goldman Sachs intended to fully capitalize on it. They formed a trading corporation, putting down a mere $1 million in capital, but immediately sold more shares to the public at 10 times the price. They raised $93 million and turned their original investment into almost $10 million. Sound familiar? This is the precursor to Special Purpose Acquisition Corporations, or SPACs, that we see today. The fourth lesson: money can be created from market euphoria. When there are people willing to pay, you can create the product. Goldman Sachs started more investment trusts simply because there were people in the market willing to pay for them. This isn't unlike the dot-com bubble of the early 2000s or the recent cryptocurrency mania. You could literally create an investment trust out of thin air, take it public, and the market would buy it. But nothing good lasts forever. Eventually, everything comes crashing down. That day was October 29, 1929. The worst crash America had seen in its short history. Goldman Sachs Trading Corporation was reduced almost to nothing. Hundreds of millions of dollars evaporated, and Goldman Sachs partnership lost $13 million of its investment. Within a year, hundreds of investment trusts went bust, taking down investors and investment banks with them. So how did Goldman Sachs, while hundreds of other firms were obliterated, not just survive, but emerge even stronger?
Chapter 4: Rising from the Ashes, the Power of Connection and Loyalty. It was all thanks to one man, Sidney Weinberg. Sidney grew up in a poor Brooklyn household, forced to quit high school early. But he possessed an extraordinary work ethic and an incredible ability to network. He started as a janitor at Goldman Sachs, hustling his way to the very top of the company in just 15 years. Sidney had a tremendous capacity for connection with other people. His clients adored him. Even after the collapse of the Goldman Sachs Trading Group, Sidney's clients chose to stay with the firm. The fifth lesson: connections are king. In business and investing, trust and personal relationships can be your most invaluable asset. Sidney Weinberg is a living testament that you don't need a fancy degree to succeed if you can build unwavering trust. Goldman Sachs's successful comeback made Sidney Weinberg hungrier than ever. He now attempted the impossible, taking Ford Motors public in 1956. Henry Ford, the founder, had famously distrusted Wall Street, calling them gamblers. Even J.P. Morgan Jr. had failed at one point. But Sidney knew that after Henry Ford's death, the next generation was ready for a shift, and he succeeded. The Ford Motors IPO was a resounding triumph, solidifying Goldman Sachs's place on Wall Street. As profits rolled in, Goldman Sachs needed to find more ways to reinvest them, and they found a new gold mine within a small trading department.
Chapter 5: The Trading Era: Risks and Bitter Lessons. That department was led by Gus Levy, a legendary trader. Gus was a calculated risk taker, and he pioneered a strategy called block trading. He learned that because the market could react unpredictably when an investor sold a large block of shares, he could negotiate a private, discounted price with the investor. He would then resell the shares gradually in the market for a profit. The sixth lesson: hunt for market inefficiencies. Those small cracks, those overlooked arbitrage opportunities, can yield massive profits if you have high leverage. By the 1960s, as Sidney Weinberg approached retirement, Gus Levy became his heir apparent. For the first time, a trader became the boss at Goldman Sachs. Under his leadership, the trading business grew drastically, becoming a major source of revenue for the firm. But
As Goldman Sachs issued more securities and engaged in trading on a larger scale, the firm became even more vulnerable. For a lot of finance companies, no matter how big they get, they're often just one mistake away from a total collapse. Goldman Sachs was about to make that mistake in 1970. When the country's largest railroad company, Penn Central, hired Goldman Sachs to issue another $100 million of commercial papers, investors poured in, believing they were a safe investment. Why? Because Goldman Sachs was their underwriter. But Penn Central went bankrupt. Its commercial paper investors were nearly wiped out and immediately started suing Goldman Sachs for misrepresentation. Goldman Sachs was ordered to pay 20 cents on the dollar to investors.
Here's the interesting part. The National Credit Office, a rating agency, gave the debt a high rating because Goldman Sachs was its underwriter, and Goldman Sachs pushed the company to issue more debt because of those high ratings. Sound like a vicious cycle? It's almost as if Goldman Sachs knew something was going to happen beforehand. But the Penn Central scandal was just a sign of things to come. As economic conditions worsened in the 1970s, more securities Goldman Sachs issued went bad. But none of this prepared Goldman Sachs for the tragedy that was about to unfold. Gus Levy died suddenly from a stroke. He left no succession plan, leaving Goldman Sachs in chaos.
Chapter 6: Rebuilding Reputation and the Golden Principles. Lessons in Business Ethics. One man changed everything. John Whitehead. A Harvard-educated Navy commander, he realized Goldman Sachs couldn't continue business as usual. The firm needed to operate like the military, where everyone must follow a code of conduct. Whitehead famously wrote Goldman Sachs's 14 business principles, emphasizing putting their clients' interests first. He standardized the investment banking business, ensuring employees provided the highest quality of service. There's a famous story of a client waiting 5 hours in the lobby just to learn a lesson in patience and the importance of waiting for those more important than you. The 7th lesson: build a strong culture and principles. Especially in an industry like finance, trustworthiness is paramount. Lost reputation can ruin you. Whitehead's leadership not only made Goldman Sachs more profitable, he also restored trustworthiness in the minds of their clients.
The 1980s were a decade of deal-making, fueled by easy money and relaxed regulations. This presented an abundant opportunity for Goldman Sachs. By 1983, they made $400 million in profit. But at the height of his power, Whitehead retired to become the Deputy Secretary of State. He passed the mantle to Steve Friedman and Robert Rubin. Robert Rubin, who built Goldman's options trading business from scratch into a major profit engine for the firm. With Rubin at the helm, Goldman seemed unstoppable. But they had no idea an unlikely adversary was coming for them.
Chapter 7: Scandals and Profits, when clients only care about the money. In 1987, Goldman Sachs senior partner Robert Freeman was arrested for insider trading. He had indirectly revealed insider information about KKR's hostile takeover of a company. This wasn't just any arrest. Rudy Giuliani, the U.S. attorney, wanted to create a public spectacle. He deliberately dragged this case as long as he could and periodically leaked information to the media. Goldman Sachs's reputation was dragged through the mud.
For an investment bank, this could be catastrophic. Clients might shun doing business with them, but they didn't. The 8th lesson: loyalty isn't always built on morals. Goldman Sachs's clients were major American corporations, and they realized that as long as Goldman Sachs kept making them money, everything else was secondary. Rubin successfully navigated Goldman Sachs out of the Black Monday crash in 1987 and legal troubles during the early 1990s. By 1993, Goldman Sachs made $2.7 billion in profit, a large part of it coming from trading. For a decade,
The firm lived under the principle of putting their clients' interests first. But that was gradually shifting. Goldman Sachs's trading business was expanding to a bigger scale, composed mostly of their own money. By 1997, Goldman Sachs had two bosses, John Corzine and Hank Paulson. But as a public company, there can only be one king, and Hank Paulson knew it.
Chapter 8: The IPO and the Public Promise, Transforming for Survival. Hank Paulson was a hyper-competitive, gold star mentality type. He was known for being an honest and trustworthy broker. Despite not getting along with Corzine, Paulson was eventually selected as the sole senior managing partner. By 1997, after bringing in $3 billion of pre-tax income for the year, Goldman Sachs was ready to go public. But an unexpected crisis was about to ruin their IPO plan. Long-Term Capital Management, LTCM, a hedge fund started by economic geniuses operating on perfect mathematical models.
But in 1998, a black swan event happened, a sovereign country defaulting on its debt. LTCM lost $353 million in a single day. Goldman Sachs immediately started dumping its own bond positions into the market, accelerating LTCM's downfall. Ultimately, the Fed stepped in to bail out LTCM, and in the process, saved Goldman Sachs. With the LTCM crisis resolved, and at the peak of the dot-com bubble, Goldman Sachs went public. They sold 11% of their shares, bringing home $3.7 billion. Going public forced Goldman Sachs to release never-before-seen information about the company. People now realized just how profitable Goldman Sachs had been. Most of that profit had been paid out to the Goldman Sachs partners. Now, as a public company, Goldman Sachs searched for more ways to make money.
Chapter 9: The Profit Machine from Crisis. Lessons from the Housing Market. By the early 2000s, a new business was booming: mortgage-backed securities, MBS, a housing boom that made no sense at all. By 2006, MBS became one of the most profitable businesses for Wall Street banks. Goldman Sachs underwrote about $203 billion of MBS in just 2 years. At the peak of his success, Hank Paulson, following Goldman Sachs tradition, left to become the U.S. Secretary of the Treasury. Lloyd Blankfein, a trader, became the next CEO. At this point, Goldman Sachs was almost like a hedge fund, managing tens of billions of their own money. Their clients began to play a lesser role. But no bull market can go on forever, and their principles of putting their clients first were about to be tested by the biggest financial storm in recent history, the 2008 mortgage meltdown. More than 70 mortgage companies failed. Bear Stearns, Lehman Brothers collapsed. The entire investment banking sector was on the verge of total ruin. Goldman Sachs, with a large exposure to subprime mortgage loans, was among the most vulnerable firms on Wall Street. Out of options, Goldman Sachs turned to an unlikely savior: Warren Buffett. His investment gave Goldman Sachs some breathing room.
To recoup from trading losses, Goldman Sachs not only unloaded its mortgage-related assets, but also started betting against them using financial derivatives called credit default swaps. Goldman Sachs figured out trouble was coming before other firms. They made a massive proprietary bet against the mortgage market. Despite criticisms for selling junk and betting against their own customers, Goldman Sachs argued that if a client wanted a type of derivative, they would create it. The 2008 scandal was just the beginning of Goldman Sachs's deteriorating reputation. Since then, they've been caught in multiple illegal activities. Yet, Despite all of that, Goldman Sachs emerged unscathed and their clients remained with the firm.
Conclusion and the final lesson: the path to outperformance. So, what's the secret to Goldman Sachs' success? They are exceptionally good at spotting money-making trends and simply executing them better than anyone else. When the bubble bursts, they are quick to cut losses and bounce back. Whenever there's a boom, Goldman Sachs is always among the first to ride it, and they're constantly seeking new opportunities, like the rise of retail investors through commission-free trading platforms. They're expanding into wealth management for the masses with Marcus Invest. Because in this game of survival of the fittest, Goldman Sachs has outlasted them all.
They are a highly disciplined and efficient firm with one singular focus: profit. The final, most crucial lessons for you. Look beyond the crowd. Don't just follow what everyone else is doing. Seek out the gaps, the unmet needs. Adapt rapidly. The market is constantly changing. The ability to pivot strategies and capitalize on new trends is key. Risk management is paramount. Know when to cut your losses, when to protect your capital. Goldman Sachs isn't afraid to dump assets to save itself. Build relationships and reputation, but understand market reality. Personal connections are invaluable, but ultimately, profit drives loyalty. Be bold and innovate. Don't be afraid to try new things, even if they're unconventional. The financial game isn't for the faint of heart. But with these lessons from one of its greatest giants, you can arm yourself to not just survive, but thrive. Are you ready to apply these strategies to your own life and business?
If you found this video valuable, don't just watch. Take action now. Subscribe to our channel for more in-depth financial and investment insights. Hit that notification bell to be the first to get game-changing information. Like and share this video with friends, family, or anyone who needs to hear the truth about how money really works. Let's build a stronger financial future together. See you in the next video.